This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Guy back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the button over Guy's picture saying, looking for the downloads. Now, Eric, let's start off with your thoughts here on the equity markets.
Well, Patrick, I have a non-consensus take on the events of the last two weekends, and my conclusion is that this equity market is more fragile than most pundits have acknowledged. The last two weekends were market fragility warnings. DeepSeek was an advancement in AI technology. We're making progress here. They proved that model training costs could be brought down and made more economical than previously understood. That's good news for AI, not bad news. What it means longer term is that the cost of training amortization is going to come down, making those $20 subscription models that were not profitable a little bit closer to profitable, or maybe profitable for some of the people that are running them. That will ultimately increase, not decrease, inference demand, which will ultimately be much higher than training demand. So arguably, this should have been bullish for NVIDIA stock, but the market completely panicked, fearing that it meant that the end of the world was coming. Now, that retracement happened, by Monday afternoon or something? It was as we came to our senses and realized it was a panic, it all got forgotten. But the point is, the market was looking for an excuse to panic in the first place. Then this past weekend, the only thing that Trump did on tariffs over the weekend was precisely what he very clearly told everyone to expect the week before in plain English. The only news that happened over the weekend was those people who assumed that Trump was bluffing and would never actually sign those tariffs into effect got proven wrong. China and Mexico both quickly capitulated, just as Trump intended, and the whole thing was once again over and done with and forgotten and retraced by Tuesday. So the question to ask yourself is, okay, if the market was ready to panic over the sky is falling, over these relatively small events, well, then what happens when we get some real news that really and truly is bearish, and bearish in a persistent way? And it's not like we don't have cause to worry that that might happen, because the Trump administration is getting bolder and bolder in its policy actions, which means that news that really and truly is bearish and stays bearish for more than just a day or two could be on the near horizon. So I think we should take these last two overreactions as a sign that the market is looking for a catalyst for a downside risk event. And as several of our guests have said, volatility is going to be the name of the game in the Trump 2.0 administration.
Well, Eric, I'll agree with that. Volatility is now here to stay. I want to look under the hood and size up what has really happened in the markets over the last couple of weeks. Clearly, it was earnings season. A lot of the Mag 7s were a mixed bag. So we have some of them ripping to all-time highs and others struggling, including obviously NVIDIA and Apple and a few of these others that are pulling back off their highs. It's very hard for these the indice to push to all-time new highs when you don't have clarity on these mega cap stocks that impact the index in terms of them being in a decisive bull trend. Even then, when you look at the breadth of the market, we have only about 50% of stocks in the S&P 500 actually trending. And so we have to have one of two scenarios really happen in order for the bull to continue, which is either all of these Mag 7s turn back up and begin trending, or the breadth breadth of the market has to widen so that there's a much wider participation driving that index higher. If the existing trend persists, then you're going to have a market that is going to be very tired and heavy with the substantial overhead resistance, which often starts to resemble topping formations. So what will prevail? A market correction that breaks the 6,000 level on the downside and gets opens the window for some mean reversion of what was a pretty solid multi-month bull run on the upside, or is there enough gas in the tank for a lot of these to bullishly break out? I think you can break it down to looking at some of the key stocks like Tesla, Apple, and even Nvidia, and see whether these stocks actually can bullishly turn back up after having been in a correction for a month or more. And if these stocks can get their mojo back on the upside, then maybe there's room still for a breakout to a fresh high, for an impulse maybe to 63 or 6,400 on the upside. All right, Eric, what are your thoughts on the dollar here?
Well, we're still trading sideways in a consolidation pattern. A sustained move above 110 or below 107 on the Dixie will be the tell for what the next directional move is likely to be.
So, Eric, on page 3, I have that U.S. dollar index chart, and I'm trying to keep it super simple. I mean, we had this amazing bull run on the dollar from October into the new year, and it broke out of a 2-year trade range bullishly on the upside. Now, we are, over the last couple of weeks, in a corrective pattern on the dollar where it's consolidating off of its highs, but we are still above the trade range that was established in the prior 2 years. It's still holding above its moving averages. And overall, the way I look at it is that if eventually the dollar was going to take a pause and consolidate that bull run, but if we generally see old dips being bought and it's staying decisively, let's say above 106, 107, then this could end up just being like a 2-3 week correction in the dollar that will ultimately prevail with a bull continuation pattern. I continue to stand on the side that the bulls are not done yet here and that there is room for there still to be another further advance. All right, Eric, let's touch on oil. What are your thoughts?
Well, we're back down to cycle lows and also clustered moving averages right around $71 on WTI. It's hard to make a directional call here with any kind of conviction because the news flow, and particularly any uncertainty around the Trump administration policy in Gaza, means, who knows what's going to happen next.
Well, Eric, on page 4, I have that chart of crude oil, and my position all along was just simply asking the question, was this just a short squeeze because everyone was piled on the shorts on oil going into December, or is this the beginning of a new bull run? So we had this $12 short squeeze to upside, which is a similar magnitude of prior short squeezes that we saw back in October and the one we saw back in June. And each time back then, it faded right back down to the lows. And so one of the things that I was looking for was whether or not the bulls would buy the dip and whether or not we saw a pattern of accumulation starting to develop, or was it simply a short covering squeeze and it would simply fall right back into its prior trade range. Well, it's now been several weeks, and it's clear at this moment that there's no sign of any buying. And unless the bulls can save this back up to $74, $75 a barrel in a very short window of time, like before our next episode, then you have to assume at this stage that oil's just back into its trade range. And that doesn't mean that there won't be a bottom here, but it means that there is no new bull phase here underway, at least not yet. And so we'll be looking technically whether or not there's a turn point in its future. Now let's touch on gold. What are your thoughts here?
Well, the formative breakout to new all-time highs that we reported on last week's podcast is no longer formative. And once again, we're flashing extreme overbought on the RSI. But breakouts can keep the market overbought for a long time, and there's still plenty of room on the chart above where we are now for higher numbers.
Well, Eric, I have that chart of gold on page 5, and we could see that decisive bull breakout out of the horizontal triangle formation that was there back in November. And so with this bull breakout, the measured move is up to 3,000. So at this moment, gold is being very well accumulated. Pattern of higher highs, higher lows, every dip being bought is still persistent. There's definitely room for another $100 an ounce on the upside toward that big round number that has been talked about all last year. The bigger question is, once we reach these upper levels, is that going to become a resistance level, or is simply gold going to consolidate and just keep plugging away in a big bull market all year? Let's take it one step at a time. Right now, about another $100 an ounce on the upside is where all the measured moves are. Let's see whether the bulls can finish these moves. All right, Eric, let's move on to uranium. You had us share this chart that you talked about with Guy. What's on your mind?
Patrick, I really think the key to this market is being told by the ocean wall chart, which we have in the post-game chart book, and which I also discussed with Guy in the feature interview. Now, after today's interview with Guy, I've now asked just about every expert I know, both here on the podcast and also off the air for some of the other people that I know. Nobody, including Guy Keller in today's interview, has a really solid narrative explanation for what caused the trend divergence between EUP and yellowcake that began right around the start of 2024. EUP, that's the enriched nuclear reactor fuel, more than doubled in calendar year 2024, while UF6, that's the output from the conversion process, was flat, and U308, or yellowcake as it's known, was actually down on the year. How is it possible that these things that are basically produced from one another are going in opposite directions? Now, of course, the bulls are very quick to say, well, this can only mean that uranium and uranium miners are about to explode to the upside any day now and catch up to EUP. But that's a little naive. You could just as easily make the opposite argument, that we have a clear trend divergence that's now a year old. So there's no reason to think that that trend divergence is going to reverse and reconverge until whatever caused that divergence to occur in the first place is reversed on a fundamental level. Now, Patrick, I have a hunch that this is being driven by some combination of conversion and enrichment bottlenecks and U.S.-Russia foreign policy deterioration. But like I said, that's a hunch, not a solid narrative that's based on sound fundamental analysis. I'm still on the hunt for a clear and concise explanation of what caused this divergence to occur in the first place. Yellowcake and the miners have to eventually turn up to reconverge with EUP. But when that reconvergence is going to happen is a question that I don't think can credibly be answered until you first establish why the divergence occurred in the first place. And of course, that began from early 2024. So I, for one, don't have that answer. Still trying to find it. If I can get a solid one that I believe in, we'll get them on the podcast.
Well, Eric, you're exactly right. That U308 simply has not gotten a pulse yet. It continues to be in a deep sideways consolidation, but we'll look for where the technical breakout points start to emerge. But right now, it's not visible. Finally, Eric, I wanted to just touch on the copper chart. On page 7, I have that descending trend line that's really encompassed the entire 2024 market correction. So now that copper here is trying to turn up, you can see it's holding above its 50-day moving average, breaking out that descending trend line, asking the very big question, is the copper going to start a new bull advance? And that's certainly something that we're going to continue to watch, whether or not the bulls can follow through, but certainly our listeners can pay attention to see whether or not something is underway here.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.